Closing beat, everybody. Happy Wednesday. How you doing out there? I hope you're having a great day. Let me tidy up here and we'll get this thing started. This is a closing beat. It's a quick show we do talking about the stock market, the good, the bad, and the ugly for the day. We've got a lot to share today, actually, so we won't waste any of your time. Rather active day here to get started. And by the way, tomorrow night, class for customers over there in the Speakeasy, we'll be talking about the stimulus bill. We'll go over all the details there as far as I understand them. There's a lot of gray areas in the stimulus bill, by the way, but we'll go over the rules as I understand them there, and come by, share a drink with me if you're one of our customers. We'll be online in the dojo tomorrow night. We're also playing a game. It's called Guess the Dow. One of our customers won last week. We always kind of cheer our customers on, but you don't need to be a client of Jazz Wealth or sending you a gift card. Also, our Jazz Artist of the Week is Dizzy Gillespie. Gotta love Dizzy Gillespie, man. Just the cheeks just going out there. So cool to watch. His song, Salt Peanuts. Come on, you know the song. You've seen it somewhere. I try to pick some songs maybe you guys know. Kind of a fun, engaging song if you want to check it out. Anyways, there you go. So here we go. Stock market. You can see it on the screen. Yes, you can. 973 down for the Dow. Very controlled day. Not really a panic selling day. Nothing aggressive. No circuit breakers, no nothing like that. You got 114 down on the S&P. It basically hovered around the 100-point mark throughout the day, bouncing back and forth, and 339 on the NASDAQ there. Last quarter was, finished yesterday. We talked about it yesterday as officially the worst quarter ever on record. Today, first day of a new quarter, this would be the second quarter, but today's performance of losing 4.41% is in fact the worst start to a new quarter since 1932. And you know what? Remember what happened back then? Did you ever study that? It was not good times. So, hey, why don't we just start over, right? If you're like the stock market or if you're a bull, let's just start over, man. Let's see what we got here. I'll take a look here at the S&P. Just a down day, still well above the lows there. The question now is slowly coming up. Hey, do you think we're going to get under these lows? A lot of people think the worst is yet to come and we could sell off. I don't think today really gave you that. I mean, yeah, we were down, and if you look at the day at the end of the day, you go, darn it, that's a nasty day. But if you look at how the day happened, it was really controlled, just slow bleeding, no panic, just, I don't know. It's just a really calm down day. Wasn't above average in terms of volume in the short term here. So that kind of sticks out to me. And now we're headed into April. Let's talk about April performance, because April's typically a good month, actually. What we did is we just put a quick chart together to show you. April typically averages a gain of 0.63%, median gain plus 1.25%. You can see most of the time April is positive. It's a decent month in terms of performance. 77.7% of the time it is positive. Best one here, 9.93. Worst, 5.82. We're already down 4.41, right? So this could be at least the worst April since '93, but we'll see what happens there. I just wanted to point out, typically it's a positive month there. This time likely to be different. We got a lot of work to do to recover all of that. I think we'd still have to sell off some more if we're going to even bounce. I don't think today's drop is going to cause people to want to bounce. So there you go. We got a little bit of seasonal tailwinds, but I think this time we all agree it's a little bit different there. All right, basically bad news today. Just when we knew the news already, it wasn't new throughout the day. The manufacturing number back into contraction territory. Trump and the coronavirus task force saying that the number of deaths just in the U.S. could be as much as 240,000. Not sure how they chose that, not 250,000, but they chose 240,000 there. Now, tomorrow we've got initial jobless claims coming out. You thought last week was bad. This, I think, is going to be... It could be a double-digit jobless claims number. Last week, we were up 3-point-something million. We added 3 million new initial jobless claims. Here in the state of Florida, you actually can't complete your application for unemployment. It's that bogged down. So I think you multiply that by all the other states, or if you just kind of take that sort of unemployment vision there, I think it's going to be a nasty, nasty number. I think it could be a double-digit day. We'll see what happens. I'll cover it, of course, there. As for things that are not involved with the virus, on Instagram, we're doing a show called Outside the Virus. Just cover real quick. I think it's a minute long. We're just covering some things that are happening outside the virus, news and events that you don't get to see. The NASDAQ today pulled back as well. You had the NASDAQ beating the S&P in terms of performance, right? So it was basically just a little bit less weak compared to the S&P 500. I'll tell you what got the brunt of it today was the Russell 2000. If you like buying severe discounts, this is just beaten down. Russell 2000 down 6.6% on the day. Holy moly, that's a bad one there. All right, let's move on. Sector update for the day here. 10 of 11 of the S&P 500 sectors today were down 3% or more. Consumer staples was the one that was not down as much. Let's talk about financials, the rare gap down here. We do not normally see financials gap down in a large way. Little gaps here and there, but you got a big gap down today, down 6%. That's a sizable gap for that one there. Look, investors are worried about a couple things. Banks and their dividends. That's the headline news today. Will the banks continue to pay the dividends, those that do? Net interest income, that's how they make money, and now how some of the brokerage firms, the only way they make money, and a spike in loan losses, meaning people that aren't going to pay their loan payments back because they don't have a job, right? So that's a concern there. Financials down a little bit today. That weighed on the market all day. We were not going to have a positive day in the stock market. Went to see a gap down like that. REITs down 6% as well. This was one of the weaker areas today. Late payments are a concern because remember, REITs, you know, they're not all apartment community related. Some of them are commercial spaces. Some of them are industrial spaces. However, I took a second. I went through some of the residential community REITs, and we went through and looked at some of the data on those. So you ready? If you've got Avalon Bay, ticker symbol AVB, it's one of the worst performers in the group there. Avalon Bay was down 6% today. They are focused on apartment communities. They've got 275 communities that are currently up and running and generating rents, 74,000 individual units, and this is the tough part. Out of the 275 communities, they've got 27 in New York, 23 in New Jersey, 9 in Connecticut, 94 in California, 19 in Washington. That's 172 out of the 275 communities they have in some of the hotbed zones. That's about 66%. If you're paying attention there, you can understand why that stock's taking a beating, because those people aren't really working. They're not really leaving their house. We're supposed to be leaving their house. So that's a tough one. AVB, the ticker symbol there, if you like that sort of thing. You got Equity Residential, ticker symbol EQR, I believe. It's not popping up. Yeah, EQR is a ticker symbol. Has 309 communities. They do a little bit different sort of thing. They try to focus on a little bit more of the high-end urban type developments there. They've got 80,000 units. Out of the 309 communities, they've got 36 in New York, New Jersey, and 108 in California. That's not good either. So now you kind of understand when these guys are solely focused on driving rents from people that possibly are going to be late or delayed their rents there. And now you've got trending topics out there like, hey, hashtag I don't want to pay my rent, which is not right, by the way. You have a deal to pay your rent. And if you don't have a job, the deal is you still pay the rent. So it's not the landlord's job to say, hey, we'll let you slide on this one. If they want to, that's fine, but I mean, that's not their job, so I don't buy that for 1 second. I don't mean to be heartless, but you got a deal. Home builders, a little bit lower today, 8% down on the day. Remember, this is not just home builders. This is things like Williams-Sonoma. That was one of the weaker spots in the category today. Tempur-Pedic, right, down 14% on the day. Mohawk Carpet, I've tried to point out some of the different names in there. One of my favorite, Floor & Decor, also lower on the day, double-digit losses. That's holding back your home builders sector. The home builders themselves weren't actually one of the weaker spots today. Transport's a little lower. That's 4% lower. Broad weakness across the board, but it's going to be airlines that lead the way to the downside. If you missed the bounce on the airlines and you wanted to buy, you may be getting your chance here, right? American Airlines hitting it, making new lows. That's the closest to making new lows. Delta Airline down 16% today. Still a little bit more to go, by the way, on that one. And United Airlines is right in the middle between Delta and American in terms of making the new lows. So those of you that missed the bounce, maybe you're coming back for the dip. I don't know. That's up to you. All right, let's check it out here. We've got a lot of cool things. Oil ended up the day just a little bit higher. You had a huge increase in stockpiles out there. I don't know if you were following along, but the increase in U.S. stockpiles up to 13.8 million. We were expecting an increase of 3 million. We got an increase of 10 million. Something tells me, by the way, that our stockpile number is going to look similar to our initial jobless claims tomorrow. If you happen to be paying attention to all the words I say, I kind of think we're going to see double digits there. We'll see what happens. Anyways, we're talking crude oil. This is the week-over-week change in stockpiles. We were expecting 3%. We got 3 million. We got 13 million. Just to give you an idea here, you got to zoom out kind of far to see the last time this happened. You're looking back in this area right here. Highest inventory that we've seen in the last 3 years. Now, that is the opposite of what you want to see as an oil investor. Here's your lesson of the day. If we take the price of oil in terms of using the USO, so everybody can play along, if you take a look at something like this, where are we at here? I'm going to try to pull it up. Nope, I got the wrong thing. There you go. Okay, so if we zoom in here just a little bit, if you take the price of oil, look at the last time we had a significant drop. When the price of oil is falling, you also want your stockpiles to be falling, not rising. Worst case, they go flat. So that's what would happen in this last little burst here. You've got the amount of oil available going down, and so is the price of oil. What that means is as the price of oil gets cheaper, more people go and consume it, but there's less of it for them to consume, and then the price starts to go up again. Look what's happening here. We have the exact opposite, which is why oil is not going anywhere anytime soon, the price of oil. You've got stockpiles rising. That's just the U.S., by the way. That doesn't take into account Russia, OPEC, OPEC plus, all those. Right? So stockpiles rising, oil prices going lower. Prices are going lower, but there's a lot of it. It's going to be a while until this happens, until this oil recovers itself. There's a couple analysts out there from the likes of a Goldman and Nomura, I believe was the other one, that are looking at sub $10 oil. Here's the current national price of gasoline, if you care. It's down to $2.10. By the way, I'll zoom out here. The last time oil was $20 a barrel, this right here is how much gas was, right? National average $1.13. So if you think prices are coming lower, they absolutely are going lower in the short term. $1.77 here in good old Florida. Pretty cool. Anyways, gas prices down 15% just in March and 21% year to date if you care. So that is that one there. Let's go on to a couple of the oil stocks. Didn't mean to get sidetracked on you. You got Whiting in the oil space filing bankruptcy. There's going to be more of these, by the way. So that's what you have there. And that's it for our sector update. Let's move on from this because I've got other things I want to share with you. Yesterday on our Outside the Virus comments on Instagram, we talked about Yum brands. That's Pizza Hut, Taco Bell, KFC is the other brand there. So we talked about they issued debt. I can't remember how much debt it was, but they issued the debt at a yield of 7.75%. And I thought, that sounds pretty attractive. Does that not sound pretty attractive? Anyways, today you've got Carnival Cruise issuing debt. They are issuing $4 billion of debt at a 12% yield. Are you interested in that? Actually, it's too late. Everybody was super interested in that, and those people that wanted to loan Carnival Cruise money for 12% returns, they actually got a chance to do that. Investors flew to that, by the way, and Carnival issued that $4 billion of debt. You get a 12% yield, assuming that they are around to pay it, and they will be. It'll be just fine there. But that's just going to show what's happening out there. These companies are issuing debt. They're paying a lot in terms of yield there. So a lot of good deals on the books. Anyways, let's take a look here. 5% of the S&P 500 is above the 50-day moving average. That's 24 stocks, basically the same, unchanged there. You got, well, hey, let's talk about it this way. Give me just a second. We're going to look at this a little bit differently here. We're going to go back to what I did is the number of stocks that are 52-week highs or close versus those that are the furthest from 52-week. I put a little something together for you so you could just see some symbols here, give you a little bit of breakdown, different way than we normally do it. And we'll pop this in. It's got to be a little bit better. There you go. We looked at both ends of the markets. I'll try to make it bigger for you. Here are, on the left-hand side, the S&P 500 closest stocks that are names that are closest to their 52-week highs. In other words, the strongest of the groups in the S&P 500. You see, you have Regeneron, Biotech, CTXS already hitting 52-week highs, just pulled back a little today. You've got a list of stocks there that are the closest to hitting 52-week highs. You got 10% or more until they get there. You go on the other side here. The stocks that are furthest from 52-week highs, in case you like looking at the weakness, I know some people are counter trend, they like that stuff. 89% on Apache, 87% Diamond Offshore, Occidental Petroleum. You see the ones in the red. The lesson of the day is most of those stocks are oil, energy related, and so that's where a lot of the weakness is. You do have retailers in there. I would like to point that out. Macy's. Kohl's in there as well. You've got Gap down here at the bottom. PVH was just reported earnings after the close. So I just wanted to share with you a different way of looking at weakness versus strength compared to just rattling off a bunch of numbers. Hope that was helpful for you. And what do we got here? Virus adjustments. That's a tough one. So every day I said I'd go through and try to find stocks that are adjusting, companies that are adjusting, anything doing good or poorly based on the virus here. And every day I've rattled off just a ton of different symbols to the point where I got tired of researching them. But just today, General Motors, Q1 sales are down. Add Toyota, Nissan, anybody else to the mix as well. Auto sales numbers were horrible. GM sales down 7%. They were expecting 4.3%. Foot Locker is closing additional stores. Didn't know they had any left open, but they're closing additional stores today. Stock was down 8%. Grainger Worldwide shares lower by 5% on the day. They drew down $1 billion effectively like we would on a credit card. It's the equivalent of us drawing $1 billion on our credit card as a cash advance. That's essentially what Grainger did there. Drew $1 billion on their credit card. Helmerich Payne almost made new lows today, down 9%. They cut their dividend from 71 cents to 25 cents. These guys are in the oil and gas space. Expect to see more of that in the oil and gas space. Try to point it out when I see it. Home Depot down 4%. They're cutting their store hours to 6 p.m., I believe. I just have Home Depot on my list. 6 p.m. I think Home Depot is going to close there. Something we probably don't think about. Match.com down 6.71% on the day. They said the virus is making it harder for them people to find love, which means the revenue is actually a little bit less because people aren't signing up to go find their match. They're actually just hanging out at home playing with their family or friends or whoever. So Match.com said their revenue growth going forward is going to be weak. All right, that was kind of a fun one. Williams-Sonoma down 11% on the day, extending their store closures for another 2 weeks and likely going to have to do it a little bit longer in the state of Florida. Caterpillar down 4% on the day. They're withholding salary increases. They're getting rid of bonuses. Nobody is getting their bonus from that. Lastly, one of the things, if the markets continue to move lower, one of the things you may want to do is stress test your portfolio against the last known weakest market. Does anybody know what the last known weakest market is? Yeah, you do. Yeah, you do. The last known weakest market was the financial crisis or the Great Recession, 2007 through 2009. So what we have been doing here, let me see, what did I got? I have to go over here. Sorry. So what we've been doing is we're trying to come up with the idea, what if we could take different portfolios that customers have, whether they're with us or not, and we could stress test them against the financial crisis? And I don't mean how did they perform during the financial crisis. I mean pretend that right now is the financial crisis and the investments themselves are going through that time period. I'll give you an example. Okay, now we'll give you an example. So here's one. One of our customers asked me to do this one for him. Not sure if he'd mind if I say his name or not, so I won't say his name. But anyways, one of our customers asked us to take a look at his target date fund. This is a 2025 Fidelity Freedom Target Date Fund. A lot of you guys probably have this in your 401k as well. What we did is we ran through how the performance of today's target date fund would do if it were the current financial crisis. So in purple, you see the target date fund in the background. In orange, you see the S&P total return there. The point being, if this turns out to be as bad or as bad as the financial crisis, this customer with this fund could expect every $10,000 they have invested in it to be worth the equivalent of $5,429. Whereas the stock market itself, a $10,000 investment would have been worth $4,680, right? So the point is to try to show how bad could it actually get in real terms, but using a previous severe decline to do that. Another great example would be Carnival Cruise here. Let me see if I can just kind of pull this in. Yeah, a little bit more so you can see it. And zoom in for you. I want you to get it all. You can imagine Carnival Cruise Lines is going to do worse and has done worse. But the current Carnival Cruise Lines would suffer to the tune of basically a 49% drop in the financial crisis. But in today's terms, of course, financial crisis, S&P dropped 42.29% in that time period there, October 15th, 2007 to March 2nd, 2009. What's the moral of the story? It's just a way to go back and say, well, look, we don't know how this market is going to pan out, so let's take a previous market where we know how it panned out. We can measure the volatility, we can measure the actual performance and everything else included, but take a current investment and weight it and measure it against something bad that's already happened. I don't know if I explained that clearly or if that came out right, but that was the idea, was to stress test funds, and I had a couple people ask me to do that, so it's something that takes a decent amount of effort on our part, but kind of fun to do, right? So you could take a look at what you have and say, how bad is it going to get before it gets bad, and then you know, all right, well, maybe I don't have to panic, or maybe you see it, you panic, and you do something about it now instead of waiting until you get emotional when the markets fall. All right. Yeah, I don't know, like, I'm not saying Carnival is a pick here. All I was trying to do was find something that was likely going to be more volatile than a 2025 target date fund, because that's not a very volatile fund right now. Anyways. For the Fidelity Freedom Fund comparison, did it change the current asset allocation or use 2008? It uses current, the way it's currently being invested. I don't know how to kind of explain it other than to say it's the current performance of the investment, but the previous performance of the stock market. In other words, incorporating the volatility, incorporating the performance. But we're using the current target date fund. So someone's going to miss that and bash me in the comment section. So let me just say it's today's target date fund, not the target date fund of 10 years ago, because naturally I know it would be obviously a different allocation. So it's today's allocation. What if right now we replicated the performance of the financial crisis? That's probably the best way I can say it. I love it. You're into stocks the way you're into politics. I don't know. Bigly, huh? Anything you own now that existed in 2008 will survive. Anything you own now that existed, well, that would be assuming that we used the 2008 performance. Not doing that. We're saying anything you have now going up against the performance of that. You're welcome, Henry. Yep. I love it. I love it. I love it. Okay, that's basically all I have for you there. I do have to cut it a little bit short today for something interesting, maybe. But I appreciate you guys joining us here today. And we'll be back tomorrow. We'll cover this all over again. Let's see. Today was, again, a very calm, sort of orderly sell-off on the day. It wasn't one of those panic days like we saw just 2 weeks ago with all that volatility. I found that to be interesting. I don't know if that tells us anything going forward through the short term, but I think it makes people second guess whether we hit a new low or not. But we'll see. We'll be back tomorrow to do it all over again. And you guys enjoy the rest of your day. Thank you so much for watching. We'll see you tomorrow.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.